General Motors, ticker symbol GM, has a market cap of $52 billion, a PE ratio of 6, and a current dividend yield of 0, as they've recently cut their dividend and suspended it due to COVID. Yet they have over 9% global automotive market share with reputable brand. So why has the stock fallen 40% year to date? And should we be buying these dips? Stick around to find out as we talk about that and more in today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. But with that being said, today we're going to analyze GM's business and Q2 earnings results. We'll do a deep dive into the financials, the top line, the bottom line, the balance sheet, as they have some liquidity issues I want to discuss. And finally, we'll conclude with an evaluation of this business using our intrinsic value calculator to see whether or not this is something we as retail investors should add to portfolios or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. As always, we'll be doing the analysis within 5 minutes, so let's jump into it. So we have GM here, a multinational automotive manufacturing company. So we all know about the automotive trends currently in the industry, and that is to shift to EV production. And as you can see, GM is following suit here, as they have now introduced binding agreements to support their plan for 1 million units of annual EV capacity in North America starting in 2025. And by 2030, they expect things to be really kicking off. And at that point, they'd be generating about $90 billion in revenues alone just from EVs. Now, that is the transition GM plans to make. But what about right now? What's currently going on? As you can see, they're having impacts with supply chain disruptions on their financials, and we'll get to that in just 1 second. So we have net revenue came in for this quarter at 36 billion, let's call it. Last year, we had $34 billion. So that is an increase year over year, and that's pretty good. After we deduct for expenses, we get to operating income of $2.1 billion versus $2.9 billion last year. So that's interesting. We can see that costs have definitely impacted GM's business. Then we have our net income figure down here of $1.7 billion for this quarter, $2.8 billion last year. So we lost about $1 billion in value here if you're a shareholder of GM. Additionally, their margins have shrunk. They've actually been halved, which is not good at all, and is the reason why we see $1.14 in earnings per share versus the $1.90, almost $2 last year. But again, they already alluded that this is due to the supply chain issues they're having. They're not able to get their hands on chips, and as soon as they get a car in the door, it's sold almost immediately. So there is demand there. It's just that they're having supply chain issues, so they're not able to meet that demand. Now, in terms of the investment opportunity, they've actually put together a decent slide here to try to get new shareholders on board, and that's because they expect to double their revenues to almost $300 billion by 2030. And additionally, they're also trying to expand their margins to 12 to 14%. Currently, I calculated it. You can fact check me on this. It's about 7%. So they're expecting to double this as well. Now, if GM can double their revenues, then double their margins, what do you think is going to happen to the bottom line? What do you think is going to happen to the stock? Now, just because a business says one thing doesn't mean that it's actually going to come true. And obviously, this is marketing material to induce shareholders to come in here and buy some shares of stock. Now, to get a better idea as to what we would potentially be buying here if we were to pick up shares of GM, let's take a look at their balance sheet here. And what they do here is they have an automotive segment, cruise segment, and then GM financial segment. What we'll be doing, just to make things easy, is we'll add up all three of these together, and we'll look at the balance sheet from that perspective. So starting with cash here, if we add up all their cash figures and the marketable securities that they convert into cash really quickly, they have about $26.5 billion in cash. And if we compare that to their debt section here, they have short-term debts here of about $31.5 billion, plus long-term debts of 16 and 61, let's call it $62 billion. Altogether, their total debt figure comes out to about $110 billion in debt. Now, if you watched our last video on Apple, they too have a debt figure of about $100 or so billion. However, they also did have about 60 or 50 billion dollars of cash sitting there on the sidelines, and they produce like 25 to 30 billion dollars in free cash flow per quarter. And I can tell you right now, GM does not have that, and that's why this is more of an issue for GM. Now, with GM Financial, this is the business segment that provides financial services such as loans and credit facilities to both retail and commercial customers. So it's no surprise that their debt figure is this high. The only issue that I currently have with that is when we compare this to the market cap of $52.8 billion, their debt figure is double the market cap. And this is the issue. They currently have, in my opinion, way too much debt than what they can afford to have. But with that being said, let's jump into the statement of cash flows. And as you can see, we're using the 6 months basis here. So they bring down the net income figures here, add back in depreciation, amortization, etc., etc. And we're left with cash from operations of altogether of about let's call it $7 billion. We deduct our $3.7 billion in capex, and we're left with, let's call it $3 billion to reward shareholders for the first 6 months of the year. And how exactly did they do that? Well, as you can see, they took on some more debt and also paid down a little bit of that debt as well. So before we jump into the calculator, I just want to point out that they have reaffirmed their 2022 guidance that they're going to have about $7 to $9 billion in free cash flow. And their earnings per share figure is going to look like $6.50 to $7.50. So we use this for our calculations in just a second. All right, so let's be optimistic here with GM. Let's assume they can achieve the top end here of about $7.50 in earnings per share with a 10% required return. They have suspended the dividend again, so we won't use that in our calculation for right now. Their average revenue rate for the past 5 years is actually negative 3%. However, their earnings per share figures have been growing at about 2% for the past 5 years. So let's assume for the first case here that we will normalize at about 4%. Let's just say, let's be conservative here, and then it'll drop down to 2% for the 5 to 10 years after that. On a 20 PE, this stock could be worth $83 per share. Now, if they can achieve that growth that they mentioned, let's say they double by 2030 across the board, and let's say by 2025 they are growing at a steady rate. Let's just give them 5% for the first 5 years here, and then this gets up to like 7% once the EVs are produced and everything. On a 25 PE, the stock would be worth about $133 per share. Now, in the very worst case scenario, GM stops growing altogether for the next 10 years on a 15 PE. This stock should be worth $47. Now, take these metrics with a grain of salt, as we are using the optimistic and best case scenario. If this thing was to drop to like $5 normalized, yeah, it changes up the numbers here quite a bit, right? So that is what you have to consider. But they do have a PE of about 6, a price to sales and a price to book ratio of less than 1, and then a price to free cash flow ratio of about 7, which is actually very cheap. And it's what we like to see for our investments. But again, the issue here with GM is that they have that mountainous pile of debt that's actually double what the market cap is currently. And while yes, assuming that they can achieve the growth that they mentioned, I think that would give them an opportunity to definitely lower and lessen the debt that they currently have on the balance sheet. But if I was to invest in this company, what I would like to see is that now that they have suspended and cut the dividend, they should be using more of the cash and the free cash flows to pay down more debt instead of bringing on more debt. And that's really where I am right now with GM. I can't just pull the trigger because the stock is cheap, because cheap can always get cheaper. And if the recession starts to hit jobs harder, people start getting laid off, less people are buying cars, well, guess what happens to that debt? It gets a lot more expensive for GM. So that's the analysis for GM stock. If you liked the video and the value investing perspective, please leave a like and drop a subscribe. And with that, I'll see you on the next one.